Good morning, everyone. Welcome to the Genghis Weekly Investor Briefing. My name is Darius from Marketing and Communications Department. We are happy to see so many of you joining us, and we're very excited for this week. We have Mathew back with us. As usual, the Genghis Weekly Investor Briefing will cover a wide range of the financial markets. We will first start with the macroeconomic and fixed income outlook for Kenya, thanks to Head of Research at Genghis, that's Churchill Ogutu. And today we have a new member of the research team also joining us, that's Wesley. We'll then move on to the equities segment. Hopefully Kevin Ginge, who's our senior equities dealer at Genghis Capital, will join us. We'll then tackle the global financial markets. Thank you to Mathew. Mathew works for EGM Securities, FX Pesa, and Genghis CDS clients have a unique opportunity to invest in the global financial markets thanks to a partnership with FX Pesa. So Mathew's just going to be telling us about what we could look out for in that particular space. As always, our webinars are interactive. We encourage you to use the Q&A tab specifically to send in any questions you may have for our experts, and we will tackle them conclusively at the end of this segment. This video will be uploaded to the Genghis YouTube channel in case you want to rewatch specific sections or you want to share it with your group of fellow investor-minded individuals, or if you just want to review a specific presentation. So I believe we could get started. Churchill, over to you.
Good morning, everyone who has joined the log call right now. Thanks, Damaris. So I'll walk you through the macroeconomic, fixed income, and before I hand it over to the equity segment. So to kickstart the presentation, just to review what happened last week in terms of this report that came out in the Kenya Gazette, the cumulative. As at the end of March, that's the revenue and the net expenditure. So in terms of the highlights, we are seeing that ordinary revenue, cumulatively, that's been from July last year up until March, end of March, it was at 1.1 trillion, of which the tax receipts was at around 1,037 billion shillings, and the non-tax revenue was at 69.7 billion shillings. In terms of the gross domestic borrowing, we hit 648 billion as at the end of March. In terms of expenditure, recurrent was 718 billion, and that already is 66% of the target for the current financial year. And development at 184 billion shillings was around 46%. And nonetheless, at this point in time, we would have expected them to have hit 75% of the target. So we are seeing that recurrent is not that badly off, but development is really lagging the target that ideally it could have met at this point in time. Disbursements to counties, it's around 201 billion. The overall is around 383 billion. And public debts, as at the end of March, was at 600 and close to 700 billion. And as a percentage of the ordinary revenue, that's 63%. So for every 100 shillings that is collected, in terms of the ordinary revenue, 63 shillings is going to service the public debt, be it the interest payment, be it also the redemption. So that already is a concerning metric. So moving on to the other, the review for the week, we saw that the division of revenue bill was, it initially had been passed in the National Assembly, and because it's dealing with counties, it had to go to Senate. So there was a special sitting last week just to sign off this bill, okay, to approve this bill and to vote this bill. So it was passed. So ideally, the division of revenue bill is the split of the ordinary revenue into what will go to the national government, what will go to the county equitable share, and also what will go to equalization fund. So that bill was passed in Parliament, and this is also part and parcel of the budget cycle for the next financial year. So, of course, the other major material news that came out last week was now the latest EPRA fuel pump prices price review. It was not in line with the expectation. All the indicators were pointing towards an increase in the fuel pump prices. but we saw what came out was a surprise. The fuel pump prices being left flat as per the last fuel pump price review. Obviously, perhaps because of the furor that attended the last fuel pump price, and that was reflected by some of the suppliers' margins, which was slashed, which made it to be, which worked in the favor of EPR to at least ensure that the prices were as they were the previous time. So in terms of macroeconomic calendar for this week is still light. We are still expecting that unemployment rate, which is long overdue. Nonetheless, there's still economic survey. I'm not too sure whether it is coming this week or next week, but something also we'll be keeping an eye on for in the coming 2 weeks. Something the economic survey just telling us the growth numbers for last year and other macroeconomic statistics. So it's quite something to keep an eye on. The other, now getting into the fixed income, secondary markets turnover was around 226 billion, 26.7 billion, which was a near 6 times increase from what we saw the previous week. The trades, not surprisingly, were on the infrastructure bond that was started trading last week. That's the IFB1 2021-18, which took the lion's share of the trading activity. Moving on to the weekly T-bills, we saw that the bids that were placed was around 21 billion. That was a performance rate of 87%. And we've seen that yields have climbed something in the order of 0.6% from the start of this year. So we're seeing that yields has been gradually going up. Moving on to the liquidity indicators for the week, in terms of the average interbank rates, it's increased marginally by around 0.03%. And in terms of the CBK intervention activities, it was just to inject liquidity in the system. And that is usually through reverse repo. The instrument that now CBK uses to inject liquidity is now the reverse repo. And just speaking towards what rationalized this liquidity injection, remember that you're coming from a point at the start of the week whereby CBK, quote unquote, mopped up 81 billion from the system through the infrastructure bond. So on balance, you find that the banking system needed some liquidity. So that, to me, necessitated the injection of liquidity for the better part of the week. So in total, CBK sought to inject 70 billion. It received 47 billion. There was one day on Wednesday, which specifically it came to sort 10 billion, but it did not receive any bids. So in total, the bids that were received last week was 47 billion. The bids that were accepted was 37.5 billion at a weighted average rate of 7.36%. So those were the statistics. So basically last week, there's a bit of some tightness in liquidity, which now necessitated CBK to come in to inject liquidity. In terms of net domestic borrowing, this is as per our calculations, is around 386 billion, and that's inclusive of the overdraft facility at the CBK. Domestic borrowing is at 71.5% of using the target of 540 billion. But nonetheless, just something I did mention earlier on, looking at the Kenya Gazette numbers, in terms of their target for the net domestic borrowing, that's 491 billion. So there's 49 billion that is inexplicable as per what we are. This 540 billion was signaled in the budget policy statement, but what we saw in the Kenya Gazette numbers, 491 billion. But I think in the course of time, we shall be able to reconcile, or rather Treasury will be able to reconcile this difference that we are seeing. So is it for 540 billion? Is it 420 billion? I think with time, we'll be able to get better clarity from Treasury. So moving on to this week, today, in particular, the maturities, there are two key maturities that are happening. The first one is the 5-year bond that was issued in 2016, that FXD1 2016-5. It has an outstanding amount of 19.5 billion, and it has a coupon payment of 14.3%. So ideally, what will happen is that last semi-coupon payment, which is around 7.6%, just halving this 14.3%, that will also be paid over and above the 19.5 billion. So if I may take you back to the auction that happened last week, remember the infrastructure bond, the bids that came in was 88 billion, of which the Apex Bank accepted 1.9 billion. But initially they were seeking 60 billion. So the difference is around 21.9 billion over and above what they sought. And to me, if I look at this maturity that is happening right now, I think that the excess 21.9 billion could be to retire this paper that is maturing today, which cumulatively, if I look at the 19.5 billion, the outstanding value amount, and then the last semi-coupon payment, which is around 7.6%. So in total, I'm saying 20.9 billion will be paid out today in this FXD1 2016-5. So I think if I just connect the dots with the excess that was picked up in the infrastructure bond, I think that excess is going to retire this bond. That's just my view. I may be wrong, but that's just my view. So in the other maturity that is happening is now the family bank. It had a corporate bond. It had a corporate bond that it issued in 2015, which was totaling 2.02 billion. So with this bond, it was quite interesting. One of the bonds was paying a fixed coupon of 13.75%, and that was around 1.3 billion shillings. There's another one which had a variable coupon rate, which was pegged on the 1H2-day T-bill, and then a premium of 2.5%. That was around 600 million shillings. And then there was another one fixed coupon rate of 14%, which was 120 million shillings. So in total, it was coming to 2 billion shillings. But nonetheless, for this particular corporate bond, the book closure started all the way back from 9th of April up until yesterday. Of course, yesterday was a weekend, but the book closure dates ran from all the way from 9th of April up until yesterday in terms of the calendar for the payments to be made today. So this paper is being retired today, 2 billion outstanding. So 2 bonds coming to retire today. I'm moving on to the week's trade. We are still bullish on the IFB1 2021-18. Our secondary market started last week, and it had the lion's activity over the week. We saw that the yields on average declined. When the auction results came out, the yield was at 12.667%. But at the end of last week, the paper averaged 12.39%. Because the coupon rate was at 12.667% and the yield came down, it meant that the price is still at a premium. The price of this bond is at a premium. So for every, say, giving you an example, for every 100,000 that you might want to invest, you'll pay something to the order of 101,000. So that's the premium that I'm talking about. But it's coming from the fact that the yields have come down from where we were initially. We expect that the yield will still come down because if you compare with another paper, another infrastructure bond, which has a longer maturity than this one. This paper is maturing in 2039. There's another infrastructure bond which is maturing in 2044. And that paper that is maturing at 2044, it has a lower yield than this 12.39% that you're seeing. So our pitch for the week is that we still expect that the yield will gradually come lower, at least to match this 2044 paper, or even lower than that. So that's where we're seeing opportunities for even investors who missed out in the primary sale to be able to come in at the secondary market. I'm not too sure whether Kevin is on the call.
So Churchill, you could proceed with the equities presentation.
Okay, thanks, Damaris. So in terms of the recap for the week, the Nairobi All Share Index increased by 4.1%, and the NSE 20 Share Index increased by 0.8%. In terms of turnover, we saw close to 14% increase to 2.3 billion over the course of equities in terms of equities turnover. Top gainers, Transcentury gaining 18.5%, BOC Gases, BOC Kenya gaining 11.7%, and also Kapchorwati gaining 9.9%. In terms of top losers, we saw Car and General declining 10%, Uchumi declining 8.7%, and Salam declining 5.2%. The top traded, the usual names, Safaricom accounting for 1% of the overall equity turnover, EABL 19%, KCB 7.9%, and Equity 6%, rounding up the top 4 traded names last week. Foreign activity, we saw that the overall participation was 65.5%, with net outflows accounting for 265.2 million. In terms of the accumulating activities, whereby investors in the inflows were mainly on Equity Group and KCB Group, and the outflows were majorly on Safaricom and EABL. Usual, the top traded names: Safaricom, Equity, EABL, KCB, and Stanbic. In terms of where Kenya stands against the African peers that we have selected, this is not all the African peers, but just a select names. We are seeing that the market price to earnings, the ratio, Kenya is at 12.5 multiple, and the average African peer that we have selected is around 10.4%. So on that metric, Kenya is deemed as overvalued on a relative basis. Dividend yield, as at the end of last week, the NASI Nairobi All Share Index had a dividend yield of 2.3%, but a comparable African market was at 4.8% last week. So even on that metric, Kenya seemed as not offering that opportunities. So that's in terms of the NSE vis-a-vis the African peers. Moving on to the corporate calendar, in the near term, let me just speak to the book closure dates that are coming up. NCBA Group, book closure is tomorrow, that's 20th of April, for the final dividend of 1 shilling and 50 cents. So ideally T+3, but working backwards. So for an investor who wanted to get access to this dividend, they could have entered in. I think the last day was last Thursday, trade Thursday, and then it settles by tomorrow for you to be able to get access into this dividend payments. Investors still have opportunities on KCB Group. The book closure date is 26th of April, so that's next week on Monday. So ideally, we're looking at to trade latest by Wednesday, so that you can be able to get into this to benefit from this 1 shilling dividend from KCB. Stanchart, final dividend of 10 shillings and 50 cents. Book closure date is next week on Tuesday. So the last day of trading is this Thursday. So as to be able to be on the books to access this, to benefit from this dividend. Kengen, next week on Thursday, 29th of April, 30 cents final dividend. So for you to be able to benefit, you have to at least trade by latest next week on Monday. Stanbic Holdings, 3 shillings 80 cents, but that's in May, 21st of May. And then the other, these names are paying either in May or June. Jubilee Holdings, 8 shillings final dividend. That was announced last week when it released its full year numbers. But the other names we've walked you through them in previous webinars. So getting on to the equities trading ideas for the week. First and foremost, we're still biased towards those strong stocks. We still haven't walked out of COVID-19 tunnel. We're still entrenched in this COVID-19 tunnel. So right now for investors, it's just to stick with those names that will be able to weather this storm of COVID-19. So we are biased on the names in the momentum portfolios that the Safaricom, despite the volatilities, short-term volatilities, at least in the long term, we're seeing that you'll be able to get opportunities. So in the momentum portfolios, we're talking about Safaricom, KCB, Equity, and EABL, and then other opportunities. So specifically for the other opportunities, for this week, we're talking about for the income-oriented investors. We have Standard in our income portfolio, and we are seeing that it has a dividend yield of 7.4%, basically looking at the 10 shillings and 50 cents dividend payment that is expected to be paid out in the near term, as compared to 142 shillings and 50 cents that it closed out as at the end of last week. And if you compare that dividend yield as compared to what the average in the banking sector is giving, which is around 3.5%, on that metric alone, dividend yield is quite attractive at 7.4%. And then the price action. What I mean by the price action yet to be fully priced in these stocks, in this stock, by the time Standard was releasing its full year 20 results, the closing price was 141 shillings a piece. As at the end of last week, it was 142 shillings and 50 cents a piece. So ordinarily, we would have expected that that counter's price would have edged up by 10 shillings and 50 cents so as to be able to fully digest that dividend. That hasn't panned out. So for an investor coming in, you still have opportunities that what I talked about earlier. Latest Thursday to buy into Standard so that you can be able to get the dividend, which dividend of 10 shillings and 50 cents a share, and that already is a dividend yield of 7% already as compared to the last price. So even if the price rallies before the book closure date comes to a close, as an opportunity, as an investor, you can either gain on the price appreciation or the dividend payment. So that's the pitch that you are putting out for this week in terms of the equities, in terms of the equity segment. Let me stop it there and invite Mathew to go through the markets.
Okay, thank you so much, Churchill, and good morning, everyone. Let me share my sorry about that.
Hey, Matthew, I'm not sure if you're speaking, but we are unable to hear you.
Hey, Damaris, can you hear me now? Today I've got a little bit of a challenge with my connection. See everything now?
Yes, let's see how it progresses. Thank you.
All right, thank you. And again, apologies for this, but we have to proceed. So out on the global markets side, yeah, last week, remember a lot has happened. And last week I was not here because I was on leave. The other week, because of the Easter holidays, we were not able to check out on the markets. A lot has happened. When we were speaking, we were talking about that if a given happened. And now, last week, the recap is US economic outlook continues into recovery. Of course, again, a drop. Can you hear me?
Goodness. Hey, Matthew, sorry, I was saying it's kind of breaking a bit.
Okay, how about now? Is it better?
Yes, now I can hear you well.
Okay, apologies about that. I was talking about still continues, and retail sales surged 10% based on the fundamentals we had last week, and jobless claims dropped, and 12-month inflation rising to 2.6. The financial optimistic amid the global recovery, and even though the inflation are rising in the US and the expectations of the Federal Reserve similar for an extended period. So indices traded near record highs, and gold again was crude oil breakout. Those are the major peaks. And moving on to what we expect the central bank and the European Central Bank policies, we want to see whether the on the direction of the interest rates and the asset purchase programs on quantitative easing. Remember, still COVID-19 in the past, it's still affecting those economies on the European side and even the Canadian side, US side. The PMI's data from Japan, Australia, Britain, and the US, we want to assess the economic performance of those various economies. You can hear me well, Damaris?
It's like at 70%. We are really focusing to pay attention.
Oh, sorry about that. Let's still proceed. The US is what's on watch, and then this data may clarify the current conditions of the US labor market. Last week we had a drop in the jobless claims. We want to see whether the same is going to happen this week, or there's gonna be an improvement. And traders again need to monitor Canada, and we have expectations that an increase in the global inflation due to the stimulus policies by the central economies. Remember, a little bit of struggle as economies are trying to, and for more of that, we have to check out on the economic calendar. There to watch on Friday in US. On Wednesday, the Canadian monetary policy and
Matthew, we've completely lost you. Hey, Matthew.
Hey, hello.
Hey,
we're back now?
Yes, yes.
Okay, all right then. Yeah, I was just saying that we're watching out for the Bank of England, especially on Wednesday. We have Governor's Bailey where the movements, Canadian dollar, the euro, right? On Friday, we have the PMIs, really very important for Japan. Packed with all these fundamentals, and they are going to show the traders where we are likely proceeding next in terms of the economic recovery, especially for the PMIs. So the interest, especially for the ECB and the bank, Euro USD, of course, because of Euro, the ECB. So last week, of course, we have, and even now we have the plunging of the US Treasury yields. That one means that the US and the optimism around the US economy, of course, weighing on the US dollar, and people are traders are yielding assets, and the interest rate decision from the ECB is likely. But when you look at the technicals, the pair of the 1.1900 level, right, and currently around 1.198 levels that we going to watch at is whether it's going to 1.2. If it's able to break the 1.2 level, then we're likely to watch out an uptrend all the way to 1.2050. But again, you don't know what might happen. Remember, we need to watch out for the news. But we have a strong at 1.190. And again, it's above 50, and anything above 1.2, directing the traders if it's unable to reach that level, then you might look up to some short positions, maybe to check out whether it will get some support along 1.1. The ECB decision is going to be very important in the direction of this pair. Next, on the USD dollar, well, the Bank of Canada, again, is going to announce its interest rates. The USD card has not been able to for the last time when we still had the same trend line, waiting to see whether it was not possible for the past couple of days. And now we want to see whether the decision by the Bank of Canada on their interest rate is going to create a move, and the insights that you will have on the COVID-19 effects and movement, because remember, Canadian dollar is an asset currency, right, or a commodity currency, just to use the right term. A little bit stronger, and we have on that interest rate decision by the Canadian, but it's on a downtrend. February, it's a downtrend, so been on a consolidation, and currently the technical levels we are 500. That's where the price is currently. And
Matthew, I think Matthew, maybe it would just be more prudent if we emailed the attendees the presentation, because it's becoming very difficult to follow, unfortunately.
All right, sure.
All right, but so sorry about that. It must be frustrating on your side as well.
I understand. You can proceed.
All right, then. Thank you so much for your understanding. Churchill, I think you could also come back into view. And attendees, like I shared in the chat section, I think it would just be better if we emailed you the presentation. And I'm sure next week we'll have sorted this matter, and Mathew can answer any questions that you have from reviewing the presentation. I'll also link his email address so that if you have a pressing query, you can directly engage with Mathew. But apologies to everyone for that. So I think I would like to dive into the Q&A session for this morning. So far, I've seen just one question come in from Ben in the chat function, and the question is directed to you, Churchill. Ben is asking, in respect to trading in equities, you need to verify the claim you have stated repeatedly that books closure for equities close T plus 3 days before the event date. That statement is true certainly for treasuries, but please confirm for equities, because the NSE price list reckons we trade come dividend today for NCBA. Churchill, have you followed with that particular concern from Ben?
Yeah, thanks, Ben. My apologies. I think I was looking at it in terms of the settlement date. And I agree with you that even as at end of last week, I haven't seen the price list act for today, but as at the end of last week, NCBA, which is closing tomorrow, was come dividend. So yeah, you can still trade today. So my apologies to Ben and also to everyone.
All right, thank you for that, Churchill. I think today people are a little hesitant, or maybe they've become pros in the financial market. We don't have a lot of questions. For me, maybe I'll ask you my last question, and if there's nothing else, maybe we can wrap up the session. I wanted to know if your views on the fact that the fuel prices didn't go up last week. I think that was a political decision more than it was an economic decision. And do you envision that continuing forward in other reviews? I like how you smelled, Churchill. It's like, huh? How is it a political decision? But I feel like they didn't raise because there was already a lot of public uproar. Like when I read the stories just before Wednesday, a lot of people are justified, they're already taking up arms. So it felt like the decision not to raise the prices was just to keep everybody calm. It just feels like there's just a lot of turmoil floating around of late, whether it's curfew or IMF or fuel, we're very frustrated. What are your thoughts, Churchill?
Quite interesting. Of course, had they followed the pricing methodology to the latter, I know that will be tweeting about how this government is insensitive or whatnot. I mean, what you've spoken about, the anger that could have been vented on Twitter. I found actually that the latest price, fuel pump price review it was extraordinary. I know that now the suppliers will do the heavy lifting because of that reduction in the suppliers' margins. Because all this, what the suppliers get oil marketers, and specifically now to the listed space, we're looking at Total, which is the listed oil marketer, are now taking it's taking the weight of these suppliers' margins because they are cut for every volume or for every liter that they sell this particular, for if it's super petrol, that's 12 shillings 39 cents. If it's diesel and kerosene, that's 12 shillings and 36 cents. But those were drastically cut, and those led to the prices being stable. Because first of all, you look at landed cost, look at the storage and distribution, get into the suppliers' margins before you come into the taxes and levies. And of course, now the government, there's this stabilization fund, which now will be meant to pay out the suppliers. But ideally, I was reading up someplace, the rationale for this stabilization fund was now for the cost of prices, now the landed cost, because now it's not to do with the suppliers' margins, which I all along, and most people thought that it's cast on stone. And so the stabilization fund was now for the landed cost because of the volatilities. I think Mathew was talking about that. One day oil is at $72 per barrel. The next day it at $59 per barrel. So these volatile swings. So the stabilization fund is meant to come in and cushion the shock, but not with the supplier's margin. So right now, I think now the government will now be paying off the suppliers the difference that ideally they were meant to pay for the suppliers. I don't think it's sustainable. I don't know how much is in this stabilization fund. So it's still a matter of conjecture. I don't know the volumes that the oil marketers imported during this period. That's a first, so that they can be paid off. So there are so many unknowns out there, but nonetheless, it was by reduction of the suppliers' margins, that also led us to receive this or to ensure that the fuel pump prices were stable as per the last one. But nonetheless, we find that it's you and me, the taxpayers. Eventually, we are the ones who fund the stabilization fund. So there could be an indirect tax somewhere to be able to pay off the suppliers' margins. So those are just my quick sentiments around it. But I don't think it's sustainable. I really don't think it's sustainable. So at some point, right now, the indicators are pointing that perhaps the next review, the prices will become off, looking at an average of $64 per barrel between start of April up until end of last week. It has averaged $64 per barrel compared to $65 per barrel in the last review. Looking at the shilling, it has appreciated significantly. I think by the end of last month, we were at 109.7 to the dollar. Right now, it was at 107.5 to the dollar. So that's a near 2% appreciation to the dollar. So that is a benefit for us or for the oil marketers. They'll spend less dollars for every importation they do, and that is a boost for us. So all indicators so far are that the next review will come down. So I don't know whether the suppliers' margins will revert back to where they were or will stick it out to what was the last fuel pump price review. That's also another layer of uncertainty. So I think that it's not sustainable, but I believe that there could be a legal notice that will come out just spelling out what really happened, because what we've seen so far is just a matter of letter between some ministries or departments or treasury. But I think by and large, we'll see it play it out in a legal notice.
All right, Churchill, thank you so much for that comprehensive answer and adding some depth to my questions. I'm glad. I see a couple of questions have come through. The first is from Vincent. His question has been upvoted. He's like, why was Uchumi on the active counters? I think it was on Friday. Maybe there were some trades on the Uchumi counters and it was captured on the NSE market report for Friday. I'm not certain.
Is it in relation to, it was the second most laggard of the week. It declined 8.7%. I think that's the question.
Okay.
But for me, we don't really cover it as such. And then it's one of those speculative trading activities. So one day people see it, the price action where it is, people just take advantage of it, either selling off or accumulating on it. So it's still speculative trading on Uchumi, where it is.
All right, thanks. Richard joined our session a little late, and I think he wanted to hear the equities recommendation for this week. I know it was Stanchart, but Churchill, maybe you could just give us a two-liner. And at the same time, I think we'll be answering Kennedy's question, because he was like, what ticker would you recommend one to buy in the NSE as of today, other than Safaricom, which is our house favorite? So I think that would be our stock picks for the week.
Thanks for that, Damaris. For the week's trade, we're looking at Stanchart, and we're coming from a point whereby they released their full year 20 results. That was around March 25th, March 26th. I don't know the exact date. March 25th, actually. And the day before, the closing price was at 141 shillings a piece. And as at the end of last week, the price was at 142 shillings, I think 50 cents or 75 cents. So as compared to other banks, be it mostly KCB, which announced a 1 shilling dividend payment, we saw that the price even rallied on KCB more over and above that 1 shilling that was announced. So for it countered even that 1 shilling dividend payment that KCB announced. But when it comes to Stanchart, despite the fact that it announced 10 shillings and 50 cents, we haven't seen that much significant uptick in the price. We're just saying from the 141 shillings to 142 shillings, it hasn't been that much. So for investors, up until it's the book closure date, which is next week on Tuesday, investors can still take seek opportunities into Stanchart and buy or take the trend. So for you to get that 10 shillings and 50 cents dividend, or if most investors catch the trend, the price will also rally and before the book closure date comes. So that's the rationale behind this week's trades on Stanchart. There's a book closure date that is coming up next week on Tuesday for the payment of 10 shillings and 50 cents. The price right now compared to pre the announcement of the trade, it hasn't moved significantly. So that's where the pitch originated from. Yeah.
Thank you so much, Churchill. Richard and Kennedy, I trust that has answered your question, and anyone else who is also looking to take up opportunities on the NSE this week. We have a question from Grace Njuguna. She's like, could Churchill kindly expound on the open market operations on liquidity? So I believe you'd been talking about mopping up of liquidity in the market. Grace would like to understand that a little bit better, kindly.
Thanks, Damaris. Thanks, Grace, for the question. So the open market operations is now the activities that the CBK has, and with the market, by the market is now the banks. So basically on any given day, the CBK comes in and assesses the liquidity trends, whether if the liquidity is higher than what it's looking at, so it comes in to mop up the excess liquidity. So say based on what they're looking at, of course, there's an average that they're looking at. And if it's if it's higher than the average, so that excess is what they will come and ideally mop up. So the tools that they use to mop up is repo, repurchase agreements, shortened as repo, or even the term auction deposits, TADs. But nonetheless, all these are technicalities. But if there's excess liquidity, the CBK comes to mop up that excess liquidity. If liquidity is lower than what it's looking at, so there's that need for the CBK to come and inject excess liquidity, to inject liquidity. And that is through reverse repo, reverse repurchase agreements, whereby it says that it will sell, or it will take some of the securities that the bank has and in turn give banks some of the monies. So collectively, that market is what we call open market operations, which Damaris at some point you thought it was OMO. I never asked you what initially OMO used to mean for you, but anyway, that's the OMO that we talk about, open market operations.
You know, Churchill, it's lucky I like you. Unanianika like this. But if you put OMO, like an investor who's new in the market has to ask these questions. So Grace, I hope you've understood OMO a little bit better. I do, but it's a continuous learning curve. Jane has a very interesting question, Jane Gavi. She wants to know what's happening to stocks like Mumias now that their shares were suspended from trading. So Churchill, what happens when account is suspended? I know there's Mumias, there's KQ that was extended, the suspension of trading in the shares. What truly happens in that period? What does it mean for shareholders?
Yeah, I think also that question dovetails with another question, I think from Kenneth, in regards to ARM segment. So what happens when a share is in suspension? And True. That also is Kenya Airways suspended. There are a number, I think 5 or 4 names that have been suspended. We're just in a limbo. We're just waiting. Either there's some modalities, or once the corporate governance issues have been sorted out, or whether there's a way of restructuring the company. So as investors, people are just in a limbo. You can't do anything. You can't. I mean, our hands are tied. So as we just wait for the announcements that come from these listed names, but more often than not, we've seen that with some of the names, it's just an extension of suspension, which I don't think it will be ad infinitum that we'll just be getting this suspension of trading. At some point, either we could see a complete delisting, we could see a complete strategic investor coming into these companies, whichever way, but ultimately we'll see some form of some closure to the issues that necessitated the suspension of trading. But at the moment, it's just to weather the storm, wait and see what happens with the names in the company, in the names that have been suspended at the moment, unfortunately.
Thanks for that. So it's a wait and see approach. And like you said, there's usually periodic updates. And if you are subscribed to any of the Genghis social media channels, we usually share the updates related to such counters. I believe we've tackled all the questions in the Q&A, and it's almost 10 o'clock. Before we conclude, I just wanted to remind everyone, in case you had missed the emails or our post on our social spaces, we're having a masterclass this Friday. Super excited, especially for people like me who thought open market operations was OMO, but we are focusing on bonds. So typically during this investor briefings, we have Churchill try to demystify some of these terms he's using, but we want to take it back to basics. So if you haven't had a chance already, please find the registration links on any of the Genghis social media platforms. You can also type in this URL, bit.ly/Genghis MFC2. That's the shortened URL, if you can catch that, for registration. It's going to be interesting, it's going to be insightful, and I believe after the Friday class on Monday, Churchill can start talking to us like peers when it comes to bonds trading. So really excited for that, and I look forward to seeing you there. If you have any other questions or concerns, please find us on our social media spaces. Mathew, again, so sorry you're having issues today, but I request for you to share with us a presentation and we'll share it with the attendees of today's session. And in case they have any questions, they'll hit you up. Is that okay?
Yeah, sure, I will. Today the internet has thrown me under the bus, but we hope next week things will be better.
It will be better. Things can only get better.
Right.
All right.
Again, apologies for that. Thank you.
All right. Awesome, Mathew. Thank you, everyone, for taking time to join us this Monday. Have a great investing week and reach out to us if you have any questions. Take care. Okay, I will type the URL for the masterclass on the chat, just in case before you leave, you can tap on it and register, but feel free to leave at your own pleasure. Thanks. Bye.